Have you ever wondered how to start investing in the stock market? Investing, in its simplest form, is about buying a piece of a business or a commodity with the expectation that it will generate profits or appreciate in value over time. It's a way to put your hard-earned money to work instead of letting it sit idle in a bank account. Investing is crucial because it offers the potential for substantial financial rewards. Think of it as a journey toward securing your financial future. The magic of compound interest, the possibility of earning dividends, and the prospect of your investments increasing in value are all compelling reasons to start investing. But let's be clear, while the potential benefits are significant, they don't come without risks. The value of investments can fall as well as rise, but that's a topic for another day. Embarking on your investment journey may seem daunting, but it doesn't have to be. Today we're going to break it down for you. First things first, you need to understand what stocks are. Picture this, you're in a bustling marketplace, but instead of fruits, vegetables, or handcrafted goods, this marketplace is trading in pieces of companies. These pieces are what we call stocks. When you buy a stock, you're buying a small fraction of a company. So, why do companies issue stocks? It's mainly to raise money. Imagine you've started a company and you need funds to grow. You could take out a loan, but that comes with interest and the pressure to pay it back quickly. Instead, you decide to split your company into 1,000,000 tiny pieces or shares and sell some of them. This way, you get the money you need and you don't have to pay it back. But what does it mean to own a stock? Well, as a stockholder, you are part owner of the company. You have a stake in the company's success or failure. If the company does well, the value of your shares could increase. This increase in value is known as capital gains. On the other hand, if the company doesn't do well, the value of your shares could decrease, leading to capital losses. Another term you may come across is dividends. Some companies, particularly those that are well established and profitable, share a portion of their profits with their shareholders. This payment is called a dividend. Not all companies pay dividends, especially those that are still growing. Instead, they might reinvest their profits back into the business. So, as a shareholder, you could potentially make money in two ways. One, from the appreciation in the price of your shares, that is, capital gains, and two, from dividends, if the company chooses to distribute them. With these basics in hand, you're ready to take the next step, opening a brokerage account. So, you're ready to invest, but where do you start with a brokerage account? A brokerage account is your ticket to the stock market. It's like a bank account, but instead of holding just cash, it can hold investments like stocks, bonds, and mutual funds. It's through this account that you'll buy and sell investments, and your broker is the one who facilitates these transactions. Now, how do you open one? It's simpler than you might think. Most brokerages offer an online application process. You fill out some personal information, choose the type of account you want, generally a standard taxable account or a tax-advantaged retirement account, and deposit some money to get started. It's that simple. But before you jump in, there are a few key factors to consider when choosing a broker. First, consider the fees. Some brokers charge a commission for every trade, while others offer commission-free trading. Be sure to understand the fee structure. Next, consider the broker's reputation and reliability. Do they have a history of providing good service? Are they regulated by a reputable financial authority? These are crucial questions to ask. Then, think about what kind of investor you plan to be. Are you a buy-and-hold investor looking for a wide range of investment options? Or are you a frequent trader who needs advanced trading tools? Different brokers cater to different types of investors, so choose one that fits your style. Also, consider the broker's educational resources. As a beginner, you'll want a broker that provides plenty of educational materials and tools to help you understand investing. Lastly, check out the broker's customer service. If you have a question or problem, you'll want to know that you can get help quickly. Once you've considered all these factors, you're ready to choose a broker and open your account. Once you have your brokerage account, you're ready to dive into the exciting world of stock picking. Now comes the fun part, choosing your first investments. The selection of your initial investments can be an exciting process, but it's important to approach it with a solid strategy and a clear understanding of your financial goals. Let's start with the basics. The first step in choosing your investments is thorough research. This means not only understanding the company you're investing in, but also keeping an eye on the broader market trends and economic indicators. It's essential to know how the company makes money, its competitive position, and its growth prospects. You should also consider the company's financial health by looking at its balance sheet, income statement, and cash flow statement. But remember, investing isn't just about choosing the best performing stocks, it's about building a portfolio that aligns with your risk tolerance and financial goals. Risk tolerance refers to your ability to endure losses in your investments. If the thought of losing money keeps you up at night, you might be better off with safer investments like bonds or index funds. Now let's talk about diversification. It's an investment strategy that involves spreading your investments across various assets to reduce risk. Think of it as not putting all your eggs in one basket. By diversifying your portfolio, you can potentially reduce the impact of a poor performing investment on your overall portfolio. Next, let's discuss the difference between growth stocks and value stocks. Growth stocks are shares in companies expected to grow at an above-average rate compared to other companies in the market. These companies might not pay dividends as they often reinvest their earnings to accelerate growth. Tech companies are a common example of growth stocks. On the other hand, value stocks are shares in companies that are considered undervalued compared to their intrinsic value. These companies are often characterized by lower price-to-earnings ratios and may pay dividends, which could be a source of regular income for investors. Choosing between growth and value stocks, or a mix of both, depends on your investment goals and risk tolerance. Growth stocks could offer higher returns but come with higher risk, while value stocks might offer steady income and are generally considered less risky. But remember, every investment comes with some level of risk, and past performance is not indicative of future results. It's crucial to regularly review and adjust your portfolio as needed to ensure it aligns with your financial goals and risk tolerance. Investing is a journey, and choosing your first investments is just the beginning. It might seem overwhelming at first, but with time, patience, and continuous learning, you can navigate the intricacies of the stock market. Remember, investing isn't about making quick money, it's about building wealth over time. So take your time, do your research, and make informed decisions. Happy investing. Investing is a long-term game, and managing risk is key to success. Let's delve into this a little further. You see, one of the biggest misconceptions about investing is that it's a quick way to make a fortune. In reality, it's more akin to planting a tree. You water it, nurture it, and over time it grows, providing you with fruits of your patience. This is the essence of long-term investing. It's about understanding that the real growth comes from allowing your investments to compound and grow over years, even decades. Now, while investing is about growth, it's also crucial to talk about risk. Every investment carries some level of risk. It's a given. However, managing this risk is what sets successful investors apart. This is where diversification comes in. Think of diversification as not putting all your eggs in one basket. By spreading your investments across different types of assets, industries, or geographical areas, you reduce the risk of any one investment drastically underperforming or even failing. It's a safety net that can help buffer against the unpredictable swings of the market. And that's the crux of it all. Long-term investing isn't about making a quick buck. It's about strategy, patience, and calculated risk-taking. It's about understanding that the journey to growing your wealth is a marathon, not a sprint. With these strategies, you can invest confidently and watch your wealth grow over time. That's it, you're now equipped with the basic knowledge to start your investment journey. We've covered understanding the stock market basics, opening a brokerage account, choosing your first investments, and managing risk for long-term success. Remember, investing is a marathon, not a sprint. Patience and consistency are your best friends. For more insightful videos on investing and personal finance, make sure to subscribe to our channel. Here's to your financial future.